Morning. A little late. It's 10:04 a.m. Eastern. We're gonna continue on this jewelry shop model. I've also got a big, well, not a big, but I'm updating the mobile home park model after I get done with this to include park owned home logic for park owned buying home, like the mobile home park can actually buy and install uh, mobile homes, rent them out, or do rent to own, and then sell them in the future. So, doing that, after I get this done, we're going to update the jewelry shop model that we were working on yesterday, get the income statement, balance sheet, cash flow statement all updated, um, and just keep on grinding here. So, don't forget, this model is, let's send out our link here. Is the sound working? Is the sound working? Yeah, okay. Live now. Don't forget to check out smarthelping.com for financial models. I've got over 100 templates and all kinds of different use cases, business logic, accounting tools. The model we're doing now is part of industry specific bundle. It is this one here, $125 one-time fee, and I'm upgrading this right now. And don't remember, you can buy all the templates on my entire site for a one-time fee of $9.99, or you can buy by category. Okay, so let's go. We left off yesterday, income statement. We need to start referencing all of that. I believe, let me see if I made any notes. These are all updated and formatted. Yeah, okay. And the monthly detail is good. This is what we'll be referencing to build the financial statements. Okay, so let's start here. So revenue, where's revenue? Let's minimize these. So row 313. Oh, get over to the end. So we have revenues, one type, just all sales revenues for all jewelry. Cost of goods sold. Right, we got inventory. Okay, so cost of goods sold is just going to be the cost to buy all of your jewelry inventory, and this is when it's actually recognized as an expense when the sale happens. So here we can go total cost of goods sold, this number here. Then you've got gross margins, operating expenses. Should be pretty straightforward. We have total fixed costs. Startup costs we have here. Okay. And then we have EBITDA, earnings before interest, tax, depreciation, amortization. All this depreciation from the CapEx schedule, it's fine. We need to do terminal value. Let's see, is that pulling? Yeah, that's a big number. We'll probably have to update that. So, and then taxes is fine. Let's look at exit value. So we're going to do trailing 12-month EBITDA. Yeah, I would agree that's probably the right metric. So let's make sure that's pulling right. So terminal value here. This is doing 12 months revenue. We want EBITDA, annualized EBITDA multiple. And we pull that from row 28. Oh, it is. It is. So it's saying 5.9 million in EBIT. I'm just making sure logic works. The numbers don't matter. Let's look at this. So 12. Yep, 5 million and then 3x 16. Yep. Okay. So that's working correctly. Just had to update some of the labels there. Now, okay, that looks good. There's our check. So income statements, perfect. We now go over to the cash flow statement, and this is the big one. So we've got customer receipts and revenue, that's fine. Payments for cost of goods sold. Now here's where we got to make sure this is working right. So payments is when you're actually purchasing the inventory, not when it's recognized as revenue. And then we're going to have to, so we've got revenue, OpEx, let's see, monthly details. So that's from that's not going to be a number in here, but we have the inventory tab here. Oh no, this is inventory balance. So let's go, I believe this was pulled from product as a service. So let's go into here and see how I did it exactly. To be consistent. Let's see, but okay, so payments for goods. So this was sum of inventory. $13. Wait a second, this is different. What? Hold on. Undo this. That is supposed to be revenue. Did I not pull from product as a service? Because this is what I'm expecting to see. I don't think I did though. Hold on. I might have to reference back to the video yesterday. What did I pull from? Was it the car dealership? I can't remember. I've been so busy. It might have been this one. Yeah, inventory balance. Okay. So in this one, I calculated inventory purchases separately right here. And this is already going through advanced schedule. Okay. Yeah, so I don't want to do that for this one. So what I need to do is this logic. Let's get the product as a service. I like this inventory logic better for the purpose of what I'm doing here. This is really good. So we're going to use this instead. Get rid of that. Okay, so months, and this is saying how many times you're buying inventory every 3 months. In this case, it'd be okay, buy inventory here. That lasts for 3 months. Buy it again. Lasts for 3 months. Buy again. Lasts for 3 months. And it's going to be equal to. Uh, let's get rid of the references to the other workbook. It's going to be equal to the expected cost of goods sold, which is the inventory you're buying in the period you're buying inventory for. So 3 months income statement, and that should be right. It should be row 14, yeah. So here it's saying, well, if I have cost of goods sold in Jan, Feb, and March of 326,000, that means I sold $326,000 worth of inventory. I need to buy those 3 months because I have a 3 here. If it was 4, it'd be for 4 months. So you can see 536. Now it'd be these 4 months, and it's just a cash flow thing. So whatever that is, we put in the first box, and the second box has to track if it's a multiple to know if it's 4 months or not. And then there, so 1, 2, 3, 4, 1, 2, 3, 4. Okay, yep, that's perfect. Okay, so that's all we really needed. So this is our actual inventory purchases. So we'll put that over here in the cash flow as a negative. This is the actual cash going out. And then let's go to, so I have that. And then I'm assuming I just don't include OPEX. So this is pulling 25 and 13. So it's non-inventory cost of goods sold plus the OPEX. And it's not including this. If it were, you'd have to just add it out. So you just don't include it because this expense, cost of goods sold, is already happening. The actual cash going out for it is here. So you don't want to double count it. Okay, we don't need that anymore. So this is good. Make sure to drag this all the way over. And let's say you're just going to buy for your jewelry shop about inventory, every 3 months, let's just say. So we've got it here, here. So every 3 months, that goes over to the cash flow statement. Make sure our OPEX is right. It's only pulling 25, which is this, and that makes sense because there's only one cost of goods sold item, which is inventory, so that's fine. Then you've got all this other stuff, taxes, CapEx, sale to business, all of that's coming in. Sale vehicle to exit. So this is an item that's not relevant to the jewelry shop, so we don't need that. We can remove that here. So sale, debt, company stock. Okay, so this last one, company stock, is what we got to do, and then we're going to get close to finishing this. So to get the minimum equity required, which is going to be what, somebody has to buy or pay into it, either investors, outside or inside, somebody. That's going to be the total equity required from startup costs and burn less any debt borrowed. And we calculate that debt, let's unhide these. The debt required, or the equity based on, so this we can delete from 614 to 679. We'll do it on here too. 679. And what we need is, well, let's insert a couple rows here because we have to do other cash flow items. Okay, other cash flow items, and we'll have CapEx, taxes, make sure we don't double count anything else. don't need this. Leverage, non-leverage, we don't need that. It's just going to be one final cash flow, and if it's leveraged or not depends on if you put in equity or debt assumptions. So remove that. I don't need this. This doesn't matter. I guess we could keep break-even month. That's okay. So here, this is just cash flow. Running cash or cumulative cash flow. And we just do, well, let's put these items in first. So give them the proper format. CapEx, taxes, exit proceeds. Anything else? Oh, yeah. So, inventory, purchases, tax, that's in there. This is inventory. This we have, okay, I think that's everything. And we'll know if it's not because we're going to be running checks here. So, all right, let's put in CapEx. That one, taxes here, exit proceeds is these two, inventory purchases is this. And let's just make it so we could sum them all up. Drag it over. And then we have debt service, and then debt service coverage. We're no longer referencing that. Okay, and we have final cash flow, which is going to be EBITDA plus these plus debt service, or minus debt service. Give these a format. All right, perfect. Now we have an error that's probably from some of the visuals that were referencing data that's no longer there, so we'll get that fixed. But let me, other cash items. Let me put this on the annual, make sure that's matching up. This is in 614. Okay. What else we got here? Here's our check. This minus this should always equal. That's good. That means we didn't miss anything. Okay. That's fine. So you can see here we're growing pretty good because our inventory purchases are just continually growing. EBITDA is dropping. Let's look at our assumptions real quick. What do we got going on for fixed costs? That's fine. That's fine. Just want to make sure this is all making sense. Let's go to the back here. So 326. Yeah, that's the number. Just seeing here. Well, I guess we're not really growing. The revenue assumptions aren't really growing. We got the same. Let's grow this at like 10%. Okay. Margins. Look fine. Now let's see what this looks like. So there's our inventory purchases happening. So the cash position is getting further and further negative. I just want to make sure nothing's wrong here. Let's look at year one. You got 3.4 million in EBITDA. You've bought 3 million in inventory. What's our revenue? We've got 7.8. Okay, yeah, that seems about right. Gross profit. These are low. And then the exit. Now, if we go over to, let's look at the balance sheet, which should be balanced, which it is. That's good. What's our inventory balance? So we're buying, then it goes down, 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 rebuy, goes down, down, down. So this seems fine. We're selling the inventory. I'm just trying to figure out why we're operating at essentially a cash flow deficit here. It's getting worse. And I don't think it's too, like, let's put this to say 2. You are buying inventory ahead of time, but only by a little bit, a month. Yeah, I mean, you're basically, the operations are breaking even. Let's see. Oh, ha. Okay, yeah, that you know why? Because we're double counting the cost of goods sold. Holy cow. This doesn't need to be in here because this, well, actually this does, but we have to add back if we're going to put that in there. We have to add back the cost of goods sold. this has to be added back because if not, you're saying, okay, we paid 44, 115, 166, paid out, and then we paid it out again here when we first bought it. So that doesn't make sense for cash flow. I knew something was weird there because that didn't make sense of why it shouldn't have been a cash flow deficit. There we go. Now the break-even month is 10. Uh, Update the annual as well. 'Cause I'm sure that's not matching. No, that's off. Yeah, that's a $24 million difference. So there we go. So 7. Okay, now we're making money. Okay, perfect, perfect. We're just rolling along here. Let's go to the fix the visuals if we can. But first, so cash flow, cumulative cash, the minimum equity required is going to be the lowest balance this gets to. So 632. So we go over to global control. 632 is our number, row number. And there we go. So we need 1.6 million to get this thing off the ground. Balance sheet, we should see a zero. We don't. We don't. This in theory should solve to 0. It should not be negative here. So let's look what's going on. Oh, make sure the cap table is pulling that. It is. We'll do all our checks on this after we got to make sure the monthly details rolling into the balance sheet correctly. So usually on this, I'll go and check the annual cash flow against the annual detail to see if we're missing. So this net change in cash is this number, which should equal, oh wait, startup costs. Startup costs. So we didn't have that in here. Let's put that in. Okay. Now, no, we still don't. So we need to be solving, this should solve to 0. What else are we missing? Okay, so here's cash flow annual, which should match. Since we're not putting equity in the annual detail, we add it here and then add this cash flow and this cash flow, and these should match. So we're out by 1204 somehow. Now I'm betting 2023 is probably the same. Oh wait, no. All right, we're out. We're out. We're out. All right, that's good to know. So the monthly and annual details match each other, but we're not matching the financial statements. So we have to figure out why we're not, what's going on here. I don't believe we need this. Yeah, see, this is what we want to see. We want to see a solve for 0 here. So we're up by a lot. There's something we're missing. 1204. That's fine. What am I missing? So that's in here. 257. Let's go to our annual. So our EBITDA is 3408. Get that. $1,204,000. What in the world is that number? So this is always puzzling. Puzzles are always fun. The question is, clearly we have a variance. And we need to figure this out so we can finish the model. $2 million. What could this be? It's not inventory. Let's make sure this matches. Let me roll these up. So total cost of goods sold is 24,680. Inventory purchases 24,680. So there's nothing weird going on there. Taxes is coming from elsewhere. These are always fun, man. When you figure out, you're like, oh, duh, of course. How did I miss that? It happens all the time. All right, let's just look at operations. So I have operations at this. And then it should be equal to minus out cost of goods sold, add in purchases, add in taxes, subtract interest. 3,686. Negative. Wait, E 612. Now we got to add these back and not subtract. So you're at 2,447, and on my cash flow, I'm at 3,4. Is that our variance? If so, we've just referenced a wrong row, which would make sense. That's 974. Income statement. What's the EBITDA here? 4,382. What's it here? 3.4 million. Big difference. Big difference. So that's definitely the error, or it's part of the error. All right, let's look at the items and see what's what. So revenue 782, 7.892. Revenue 7,892. Cost of goods sold 3,067. 3,067. Gross profit 4,824. 4,824. Fixed costs 312. 312, and then just startup costs 130. Well, what? And then 4,382. And I'm at 3,408. Oh, right here. 1,104. These costs: franchise fee, other fees as a percentage of revenue, and sales tax, if applicable. Basically, these are all just percentages of revenue. whatever they might be. You could use them as a catch-all or whatever the case is. Okay, so we need to add those. So 562, 3, and 4. Let's put these in here. And when you're doing these accounting issues or trying to solve, even if you know the error you're fixing isn't exactly what is causing it, you'll get closer to solving the issue every time you fix something that's off, and then you could hopefully find an exact match issue. Okay, now let's look. All right, so off by 100,000 even, and then these are all matching. So we're only up by 100K, and that actually might be just financing, which is should be in here. Yeah, it is there. Usually I offset this on the monthly if it's on the first, so if it's on the first month it comes into here. Otherwise it can go over, and then on the annual we just reference it there, and then this is summus. Okay, so we're still matched up on this, which is good. Balance sheet. Why am I off by this 100K? I guess where's the minimum month? In month 1, it looks like. So period, this should be where our 0 is in the balance sheet, but it's 100K off, which is this dead amount. I'm just trying to figure out. If that is logical. Cash flow. Well, let's put some burn in here. Because right now, let's see. Right now we're doing operational profit on these side months. Let's make this for year 1 lower. So to do that, let's just lower the sales. Again, these are all arbitrary. If you were filling this out, you'd fill in your own numbers. I just need to make sure the logic works. Okay, let me just see if we got a little negative. Still positive. But now this is lower, so our max negative is higher. Okay, so let's go. Nope. Okay, so we're out 100. This 100K is an issue, so it does mean there's an error in the flow. Somehow we're double counting that somewhere. Oh, well, it's because it's saying it's not counted in here. That's why. So we gotta include, well, hold on, that's fine, but we gotta include this. And that's gotta be drug all the way over. Okay, my goodness, I think it's good now. There we go. Solve for 0. Thank goodness. Balance sheet looks good. Otherwise, man, that's how this goes sometimes. Now our break-even month is back to month 16. We can see cash flow, cumulative cash flow. I'll pull these up. All right, break even. We don't want this tab actually. Well, I guess I could. Hold on. We just removed this last reference. That's fine. So it's just doing variable cost, fixed cost. These variable costs are just basically those percentages defined on the right here. We'll keep that. This is telling you how much revenue you need to break even based on those assumptions of variable and fixed. Valuation. We don't really need this, but it's not completely useless. Let's clear this. So assuming you do a 5-year and then just valuing the EBITDA or revenues, yeah, that's fine. This can stay. Enterprise discounted cash flow valuation. Okay, so here, yep, we got rid of that one. We don't need that chart anymore. Bring this up. The rest of this looks good. Let's give these a white fill. Same with this. Cumulative. This is just regular cash, not leveraged. Let's remove the reference error here. That's where the error was coming from. Perfect. Right. Returns. Oh man, let me format this. I don't know if this is still relevant either. Oh, just as leverage versus non-leverage. Yeah, this is not relevant. So we'll remove this, and we have our own discounted cash flow analysis that's going to happen here. One-time costs. We don't need that, but we do have other things now. So if we reference our annual tab, we have these different items. See, is that everything? I hope. Yeah, startup cost was the last of it. I did like the overview tab here, so I want to keep this. Oh, we need to see E, F. Yeah, this is offset. So CapEx is there. Let's just do all positives. That, and then startup cost is plus this, or minus. So EBITDA minus, 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 plus, minus, minus. this is coming through as a positive. Add back cost of goods sold. Okay, 30,715,000. Perfect, we match up. Now I can keep this overview section, which I like. Cash requirement of the project. We'll just do investors, insiders. Financing is still there. That's good. So investor equity, owner equity, total investment. I'll get rid of this. And then this is not relevant. Financing, investment. Yeah, this is fine. We'll keep all this. Make sure there's no errors in these charts. It doesn't look like it. Okay, so yeah, we got to preserve a lot of that overview, which I did like. Distribution. So here we need to update the reference to the monthly cash flow, which is in 631. Whoops, 631. Let's update the whole thing. What are we missing? Year is in row 1. We're doing row 2. And then this can be, we have it. So there's any monthly positive cash flows from period 1 to 60. And then this is any negative from 1 to 60. And then remaining equity to use is simply going to be this total equity minus startup costs, which I think is a positive value. Yeah, so startup costs plus any financing. So 1553 left, cap table, this is good. Let's format this with the brackets. And so there we have our internal rate of return on an annual basis of the whole project, discounted cash flow analysis, and then here is the investor cash flow and owner cash flow. And this should match. Well, first check is this plus this minus that should always be 0. And also the sum of all of these here should be equal to the ending annual cash flow here. Oh, what happened? I'm missing 100,000 again. So this is missing it. Why? That's why. Gotta add that to here as well. Okay. So this matches. These all match. This matches, so this has to be correct. We've got a nice summary here. Kind of like this how it's red and then clear. Investor versus owner cash flow. Let's just change that because normally your investors are going to be more. So where are we at? Cap table. Let's put this up to like, again, the numbers are arbitrary. There we go. We're all checked out here. This looks good. 71.8, 512.4 should match. 71.8, 512.4, perfect. Okay, and then executive summary is kind of like the overview we did, but let's just do it here. So sales, is that number. Cost of goods sold is this one. Expenses is, remember to add these two. Don't forget franchise fee, other fee if they exist, plus other fixed. And really this is SG&A, sales general administrative. Here, that's fine. Coverage. Now, are these all hooked in? No. Okay, so debt service. That's right. That's fine. Update this. This is not relevant for this model. Inventory, that looks correct. Okay, and this minus here. Oh, missed it. All right, so that's catching everything, so we're good there. These are all referenced pre on the distribution, on the import, so those are good. Yep. Okay. I think we're ready for sanity checks, and this model will be completed. So we have annual net income versus monthly. Income statement, annual 59. Correct. Balance sheet is 60, monthly and annual. These are the biggest checks. Correct, correct. That's good. Make sure these are all drug up. Annual detail, monthly versus annual. And this is just so you can see all the sanity checks in one spot and you don't have to look around every single tab. Against the balance sheet. Now this is checking this balance against the balance sheet on the cash flow, and then you got to add back equity because that's not on the annual detail. Good. Executive summary. that one. Distributions. And actually we've done that right there. And then cap table is already done. These are all correct. So you can see how nice it is doing the import and find and replace with all these tabs already referencing the same position logic. I didn't have to do anything here. It's just already working. All right, let's test, do a couple changes to things. Let's do no debt, make sure we're still balanced. Let's do debt on a different month. Let's say some month in the future. Good, that's all working. All good. Let's put that back to the first month of the forecast. Let's try no terminal value, looking good. Let's try a partial end month. Good. Let's try the end of the previous year, looking good. Partial net year, looking good. And then, so here, these are where all the main problems come once all of the logic is done, is doing the sanity checks on when the timing changes of things, and if you include that or not. So Route 17, what is the annual detail against balance sheet? So which, first make sure the balance sheet's balanced. Yep, it is. It is. So I'm assuming this is something, if I had to guess, it's debt service not stopping, if I had to guess. Let's see. So this is all working right. Let's look at the monthly detail. Yep. So you can see there that debt service had no logic to stop it. So we need to say if this is greater than the end month of the template forecast, then 0. And we could do that for the principal. And we drag this over. Perfect. The annual tab doesn't need to be adjusted because that's just pulling from the monthly. That looks good. That's why we always do sanity checks. Okay. Oh, what? Now we're up by 51,000. Let's look at the cash flow statement. So everything stops after month 45. So let's look here. Is there anything else that's happening? Let's see, we get to here, 9820, and then everything stops. Wait, what? Why is debt ser? Oh, shoot, I didn't lock it. I bet you I didn't lock it. Yeah, I didn't. All right, we'll lock that, and now, perfect. Okay. Now we're matched up. So partial month, let's put yes. That's fine. Let's go partial end year here. Good. Good. And then the partial here. The last year. Yes and no, that's fine. And then end year. Yes and no. Okay, so sanity checks are good. All right. Well, jewelry shop slash retail business front all done. The main value here in this model is the revenue forecasting is very granular. You can do, up to three tier types with up to, what do we got here? A bunch of one, two, three, four, five, six, seven, eight different categories with a bunch of different subcategories. And you can define revenues based on how you think those will perform over time and the relevant margins. And that's the main reason why, and to populate that with the pro forma is really difficult. So that's why this is a $125 model. Also defining the margins for each category and tier of category. So now we've just, and it's just gotten an upgrade. I'm not raising the price, it's still 125, but now you've got income statement, balance sheet, including inventory here, and it all balances, it all works. So a pretty cool model. I'm happy to do the upgrade. Now next week, I don't know what we're doing next week. I'll have to, let me look at the log here. Oh wait, I don't have access on this, my YouTube email. I think it is, let's see. Let's see. Log. So this was the jewelry shop. Next week we are going to upgrade something. And then when we're done with that, and also this week I'm actually, I don't know if I'm streaming it or not, but I'm working on upgrading the mobile home park. And when I'm done with that, I will do a video explaining what's updating, but it's just adding park-owned homes to the model. Okay, where am I at here on my upgrade list? So enterprise, we did that one. Jewelry. Okay, so I've got mixed use, which is a real estate model. And I don't know. So these are more complicated. The real estate models are more of trying to figure out cash flow and distribution hurdles. So I don't think I'm going to do anything with that. It's good how it is. So the next one that makes sense would be the auto repair. So auto repair, then we got ATM, startup model, and then golf course, apple orchard, hair salon, e-commerce. I did that one. Religious organization. I don't know if we'll do anything with that. I'm just seeing how many we have left. A kind of executive driven model. That's definitely going to be done. Driving range. Yep, that'll be a good one. We're getting to the end. Flat fee lending. That will be one to do. That'll be a crazy one. Vending machine. Yep, we'll do that. Bike shop. Pawn shop. 3D printing. Yeah, I mean, we're getting to the end, which is awesome. Which is really awesome. So I'm gonna then I could spend this time instead of upgrading these, I could spend time just doing new models and new logic, new business logic of all kinds of stuff. So, but I'm really happy because now I can say any startup model on here is gonna have a three statement model and cap table, which is a big improvement because I had, you know, 50 or 60 of those, and none of them had financial statements that were formal. They all had monthly and annual details and cash flow, and you could figure out, and it had EBITDA, but it didn't have anything formatted within like income statement, balance sheet, cash flow with all interconnected. Now they all are going to when I'm done with all these. It looks like I only got about 10 left, and then I'll have finished. I mean, I don't know, I might be missing a few in there, but um, we'll definitely know because I could see all my templates to see what's got it and not. But it's a undertaking. I'm happy to do it though. We're finished here. Like I said, we'll do the mobile home park. Don't forget, you can buy all the templates I've got, $999 on smarthelping.com. Get in there, huge value, or buy by category, joint venture, waterfall distribution, SaaS, industry specific, accounting and finance tools. I have more than just startup models, so these are a lot of great tools that you can use if you're in accounting departments. Cash conversion cycle, accounting ratios, pricing, inventory within a three statement model. This is a cool one. Accounts receivable and payable tracking, inventory management, multiple locations, cost of goods sold, FIFO based inventory valuation. This was a really, really good one. Real estate calculators and underwriting models. Obviously, I'm spending a lot of time building new models in this section, as well as upgrading. Like I said, the mobile home park is going to get a big one with park-owned homes. Human resource tools, personal finance, just general Google Sheet architectures that are cool. Sales pipeline, CRM, and Google Sheets and Excel, and the general valuation models, and some free stuff. All right. Well, I'm done for the day. Now, I mean, I've got a mountain of work to do, but I'm done streaming, so have a good one, and we'll see you guys probably. Well, I'll have to do the overview video for this jewelry shop model, and then hopefully get the mobile home park thing done this week as well. Alrighty.